Good morning, everyone. My name is Jared Sullivan, and I'm the Global Investment Strategist for the multi-asset funds of Ashburton Investments. And today we'll be discussing how economies will adjust to the post-COVID-19 world. I think to set the scenes, it's important to review what is happening from the high-frequency data perspective, because that is a good precursor in terms of what is likely to continue happening. So, in terms of entering into a COVID-19 state, a lot of economies around the world entered into deep recessions. However, subsequently, we've seen some sharp recoveries, most notably in China. So on the left-hand side, if we look at the China composite PMI, which indicates any reading above 50 is an expansion in both manufacturing and services activity, whereas any reading below 50 indicates a contraction in manufacturing and services. We've seen a much sharper recovery in the China composite PMI, which has worked out very well in our funds in terms of being overweight from an emerging market perspective. And this could have some serious legs in the future, given the attractive valuation entry points, as well as opportunity that we see within the broader emerging market space. However, with the subsequent recovery in a lot of economies around the world, we haven't seen a notable uptick in the inflation backdrop. So if you look towards the right-hand side of the graph, you would see that inflation does remain below target in many countries around the world and has done so for some time. This has been for several reasons, such as excess capacity, technology, but most importantly, this has been demographic reasons. So to speak about the next slide, while we've seen quite a low inflation and growth backdrop in many economies, particularly in the developed market space around the world, has been because of demographics. More elderly skewed populations that view inflation as the enemy because it erodes purchasing power at a much faster rate. So looking toward the future, we are taking this into account in terms of how we perceive the world across the funds and the opportunity thereof. So we think that skilled immigration will be incredibly crucial in terms of propelling both growth and the inflation backdrop for many economies around the world. There's three major components that are important in terms of propelling the growth backdrop. One being technological advancement, capital investment, and labor force participation growth, hence the need for skilled immigration in many economies around the world. To speak about what is likely to transpire in many economies around the world is very high indebtedness. This is both ubiquitous on a sovereign and corporate level. So if we point our attention to the right-hand side over here, what we've crudely defined as zombie companies, which is companies which have interest expense exceed their corporate cash flow generation, we would see that roughly 1 in every 5 companies on the S&P are currently experiencing this at an unprecedentedly low interest rate environment. So we believe that interest rates in a post-COVID world are certainly likely to keep lower for longer. Looking at the central bank response that we've had to date, we can see that across economies around the world, such as the Bank of Japan, the European Central Bank, as well as the Federal Reserve, have all expanded their balance sheets as a proportion of GDP. And especially the Fed, which has rapidly lowered their central bank policy rate to try and stimulate growth in the economy, inflation, and has certainly been a liquidity boost toward equity market with the subsequent recovery that we've had from the March and April lows. And we think that central banks are likely to continue to intervene to monetize fiscal deficits in the future. To speak about some catalysts that have happened in the COVID-19 period, the home improvement industry comes to mind. So there's been a lot of do-it-yourself activity at home, where if you look on the left-hand side, US hardware spend is highly correlated with what's happened to the Home Depot share price. And that does suggest that a lot of DIY activity is certainly taking place, which has certainly been the case locally in South Africa and in many markets in the offshore space. What has also been a nice catalyst offshore is that there's been a shortage of affordable homes for sale. So if you look at the ratio for houses for sale versus houses sold, that has been on a downward trend in recent quarters. So that could be a clear catalyst for the building industry in terms of what can potentially propel that in a post-COVID world, as many individuals adapt to a work-from-home environment. E-commerce sales, as a proportion of total retail sales, have soared on a year-to-date basis, coming from just over 11% at the end of last year to just over 16% at the latest available data point. So a lot of individuals have engaged in the online space, with internet penetration rates increasing significantly over the past couple of years. And perhaps the 5 largest beneficiaries of this have been the likes of the Microsoft, Apple's, Amazon's, Facebook's, and Alphabet's of the world, which make up a significant proportion of the S&P. And if you look at the return on invested capital ratios, they have been doing relatively well in recent quarters. To speak about what is likely to happen in the retail store space, we can see that using Walmart as a study case here, the increase in the number of stores for Walmart, specifically in the US, has increased at a decelerated pace. And if you look at the growth rate of the increase in stores, they are forecast to be much lower in the future because of the emergence of e-commerce coming to fruition. And to even look at the occupancy rates on a retail level, even before COVID-19, they have been on a downward trend. So what we feel may potentially transpire is that COVID-19 has potentially exacerbated a trend where the user experience is likely to move more permanently to online than your traditional brick and mortar space. To take a look at what is likely to happen in the day-to-day working environment, as you can see, occupancy rates in the office space have been relatively sluggish in previous quarters. So we think that the work from home movement is certainly going to gather traction, as well as the fact that we're likely to see more self-employment transpire in a post-COVID-19 world, as well as freelance-related work, which can potentially help offer their services to companies to cope with the changes that are likely to happen with a shift to the online space. To take a very long look at the historical trend in terms of overall vehicle sales using the US as a case study, you would see that within different cycles, the uptick in light vehicle sales as a proportion of the population has trended up in previous cycles, but has reached lower highs as the years have gone by. Now, what this does suggest is that with the likelihood of less travel likely coming to fruition in the future, we think that this could potentially limit the need for vehicle usage, given the fact that potentially less travel is likely to transpire, as well as the traction that is likely to come about with the work from home movement. This is certainly a trend that we're going to be watching closely in terms of what the replacement cycles for vehicles are likely to look like in the future, and it is certainly likely to hit lower highs compared to previous cycles. A very interesting trend that has emerged more recently is the emergence of 5G. And according to Bloomberg forecasts, this is expected to become increasingly ubiquitous around the globe, with the likes of the US, Argentina, Brazil, developed and emerging economies that are likely to benefit from this new technology. If you look at what 5G offers, it is potentially likely to be even up to 100 times faster than 4G, which has its place certainly for businesses operating in a post-COVID-19 world where the use of online and digitized platforms is going to be incredibly important for the use of a lot of economies around the globe. This is certainly a trend that we're going to be watching quite closely, and we're going to take a look at the potential beneficiaries on a global level for a lot of these economies around the world for that are likely to benefit in terms of the 5G rollouts. One trend that we've seen more recently is the use of the Zoom share price, which has more than increased by 5 times since the beginning of the year. So in our day-to-day working environments, the use of Microsoft Teams, the likes of Zoom, etc., has become an increasingly important part in terms of how we engage both from an internal perspective and from an external perspective. And we think that this is going to be the new norm. There's certainly likely to be less business travel because of the engagement to be more efficient potentially with internal and external stakeholders with the use of these digitized platforms, where it makes engagement a lot easier, a lot more friendly, and a lot quicker potentially in certain use cases where this will definitely be the future, and it's certainly the way where a lot of companies have adapted to operate on the day-to-day environment. If we take a look at what has happened from a globalization perspective, on the left-hand side, if you look at merchandise trade, which is made up of exports and imports expressed as a proportion of GDP, we would see that the globalization era actually peaked in the run-up to the financial crisis. And in recent years, we've seen that ratio come off a bit. So what has potentially taken the place is the emergence of the services economy. So the two powerhouses of the world, two largest economies being the US and China, have significantly increased their services as a proportion of their GDPs and total consumer expenditure. So as we mentioned earlier, the likes of the big tech stocks, the engagement of the fintech players, as well as where the globe is moving, where services are becoming increasingly important, with the focus is being on customer centricity. So that is likely to be a trend that is going to continue in the future, particularly as we move to more digitized platforms. To take a look at what has specifically happened in the emerging market space, we see that China has significantly recovered at a much faster pace than many markets around the world. And again, to reiterate, this is done very well in terms of our a favorable bias towards emerging markets over the last couple of months, which has led a very good and sharp recovery in a lot of our multi-asset funds. What is very interesting in this scenario is that emerging markets and the dollar have a high inverse correlation to one another. So if I point your attention to the right-hand side of the graph, you would see that emerging markets and the dollar spot index definitely have a sharp inverse correlation to one another. So if the potential thesis is for dollar weakness over the medium term, we feel that potentially the emerging market space might be a beneficiary in that regard. There's been very attractive corporate earnings growth rates, very attractive valuation entry points, and good catalysts with the shift to online and the e-commerce space in emerging markets, as well as developed markets around the world. So this is something that we will be monitoring quite closely, and something that we will potentially looking to take advantage of across the multi-asset funds. To take a look at the innovative disruption that has transpired within the fintech space, we would see that there's been quite a significant and increased focus on customer centricity across various fintech players. If you look at the likes of Square, Black Knight, etc., which have had very good share price returns on a year-to-date basis, they offer very innovative models that focus on the customer centricity, with innovative payment solutions, innovative online auctions, etc., all platforms which are becoming increasingly digitized and geared toward the e-commerce space. And we potentially think that this will be the future, and something that many economies around the world will need to adopt to within the financial service offering going forward. So we think that this is certainly going to be an area of opportunity that we'll be paying close attention to make sure that we are incorporating a lot of these beneficiaries within the fintech space, potentially in the fund framework, and making sure that we do our due diligence before our investment framework takes place. To take a look at what has happened in the online learning space, we expect this to be more ubiquitous. So very well-known online platforms such as the likes of Coursera, edX, FutureLearn, Class Central have significantly increased their subscriber growth from the beginning of the year. So if you take a look at the number of new subscriber growth, it has more than doubled in some cases. So just taking a look at Coursera, which has more than doubled before even the end of the year has taken place. So we think that this is going to be more ubiquitous, certainly a place where students are going to engage from, and going to be a key avenue in terms of skills obtainment in the future. So this is certainly going to be where the new norm is likely to transpire in terms of online education, where it potentially could be a lot cheaper, faster, as well as more engaging in terms of what is likely to happen in the education space going forward. To take a look at what is likely to happen in terms of climate change, so with global carbon emissions from fossil fuels, we would see that if we compare the previous decade to the decade before that, so in the run-up to the financial crisis, we see that fossil fuels had a much steeper gradient in terms of the emissions that had taken place in the run-up to the financial crisis in 2008. However, more recently, the gradient has become less steep, where global carbon emissions from fossil fuels have become less apparent. And we think that potentially investors and companies at large will like to focus on the ESG space, where there could be potential carbon credit trading and more efficient use of energy, where this will become more environmentally friendly, the potential for less travel because of the work from home movement that's transpiring, specifically business travel could also be less in that regard, which would potentially curtail the use of fossil fuels, where we would have a much greener push and a more energy efficient climate in the future. So we think that this is certainly going to be the case going forward, and is something that we will be paying close attention to in our funds. To end off, we see various opportunities playing out over the short to long term. So with the easing of lockdown restrictions, we see that a lot of companies are likely to benefit from consumption normalization. Your defensive retailers, your more inelastic expenditure for consumers is potentially likely to benefit and continue benefiting in the short term, being our defined period of between 1 to 2 years. So we think that demand is expected to return to normal as these mobility restrictions are lifted and as lockdown measures are eased. Over the medium-term outlook, over 2 to 4 years, we see that potential fiscal support, not only from the United States, but from many economies around the world, is likely to be apparent in terms of trying to really quell any demand destruction that has taken place during lockdown periods and the adverse impact that this has had on businesses. So we think this will be a much needed response in order to stimulate employment, to stimulate corporate earnings, to really support the economy in a very uncertain period in the future. So we believe that this is definitely going to be an important area where governments will need to come together collectively in order to support economies over the medium term. On a long-term basis, being our defined period of about 5 years to more, we think that virtualization and digitization of businesses is expected to be where businesses and many corporates around the world are likely to invest in. So our typical day-to-day operating, working from home, and many corporates around the world, we think this is going to certainly become the new norm. So we expect to see major investment from many corporates around the world that are likely to invest in a location-agnostic working model to support the shift to the virtualization environment. So we think that is certainly going to be the future, where companies are a lot more flexible and have a lot more buy-in into this sort of environment, and may even look at this as an avenue to clamp down on costs in the future as we proceed into the post-COVID-19 world. We think this will certainly be where companies will look towards to be more efficient, potentially lean in some cases, but also potentially even creating jobs to help support this digitization and virtualization framework that is likely to become increasingly apparent as time goes by, particularly in the long term, where we believe there will be a permanent shift in the e-commerce space. So we think that will be a major beneficiary in terms of what is already happening before COVID, whereas COVID-19 has just catalyzed the movement to the e-commerce space and into engaging with online technological platforms in general. So we think this is going to certainly be the status quo in the long term, and certainly where the area of opportunity is going to be. So we'll be paying close attention to many corporates and economies around the world in terms of first adopters and how quickly a lot of countries and corporates around the world will be adopting this location agnostic working model in the future. So thank you very much for your time today, everyone. I would like to hand over to our CRO, Patrice Rousseau of Ashburton Investments, who will be having an in-depth property discussion with our F&B property expert, John Luce. Thank you very much for your time. Much appreciated.